What is up, Hot Take Nation? It is DRW here, coming to you from World Broadcast Headquarters, shag carpet and all, and I am really excited about today's show. Hedging is a huge topic, especially when you see the volatility that we've seen in the market. Oil was 60, it was 48, it was 52. Natural gas has moved from 250 down to $1.75. We're having 7-8% moves in the market almost on any given day in natural gas. And so what a better way to talk about that topic than the two guests that have come. Rob Via and Matt Marshall have joined me here from AEGIS. Welcome to the show, guys.
Thanks for having us.
Thanks, David.
Would love Rob for you to give introduction on AEGIS, what you do, clients, customers, and sort of tee us up for the conversation we're going to have with Matt around the actual physical hedging of commodities.
Yeah, absolutely. So we're a full-service financial hedge advisor, and we can assist our clients on that side through three platforms. The first being our View group, which Matt leads, and that's our market analytics and fundamentals, the research side, taking our view on the market. Second platform is our hedge strategy and trade execution group. So building the unique strategies for our client base, executing, sitting between the E&Ps and their counterparties and executing the trades efficiently and cost effectively. And then finally, our back office group and technology group, Flow, does all the back office work, operations side through settlement on the open positions. From a standpoint of client base, we work with a little over 170 E&P entities, and we manage about 2.5 million BOE a day of hedgeable volumes across that base. And client base runs the gamut from small family office, call it 250 BOE a day, all the way up to large publics in excess of about 350,000 BOE a day.
Okay, so we have a good market sample here.
Absolutely.
And Matt?
Yeah, I'm Matt Marshall. I lead our market analysis piece at AEGIS, and my primary role is just to counsel clients on explaining why prices have moved the way they've been moving, explain a little bit about what we think are the major factors that could move price in the future, and then help them match our point of view on where we think prices are going with their particular risks in their current portfolio, and how should they put on hedges to protect themselves against price moves, and what's the right timing to do that. And so I work with all those producers, and I think we have a unique insight into the U.S. oil and gas market in that we see so much of that production through our client set that I think we get a little extra information about how things are going on the ground.
Absolutely.
So I'll ask the question, why are prices moving so much? Let's start with crude. I think crude has had the probably biggest move down, relative to where gas is at. So walk me through crude. What's going on?
Yeah, I mean, recently the biggest news that you just can't get away from, it doesn't matter what else is going on in the market, and that is this COVID-19 virus, the coronavirus that came out of central China. And the real effect on the market immediately was quarantine, as people could not travel, they couldn't use refined products, petroleum products, which meant that the refineries didn't need to run to create the refined products, which means that they didn't need to consume as much crude oil. And that was the direct effect on the global market. And so cargoes get turned away. Oil goes into storage rather than to the refinery. You're not making gasoline and diesel. That was the most immediate impact. And really, it wasn't just about the immediate loss of demand. It was the threat of continued loss of demand, and that loss of demand could extend to other places besides central China.
So if I want to estimate the impact, I mean, I read the news, and so in some hands, people think about global demand coming down 500,000 barrels a day. The coronavirus has been sort of a 45-day phenomenon. Probably the bulk of it's been 30 days. So 500,000 barrels over 30 days translates into what, 5 million barrels of instantaneous demand loss so far? And then how does one calculate it? Like, how does one see the flows of all the oil moving around the world to know, like, how much are we actually down in terms of demand today?
Yeah, great question. So I'm glad you threw out the 500 a day, because there's a little bit different math going on. I think that some of the 500,000 barrel a day demand loss estimates are really, if you take it for the whole year and you assume that finally the demand comes back sometime this year, the instantaneous demand loss might be closer to 3 million barrels a day. And we've seen data from inside China from the independent refineries stop taking crude. We've seen reports of inventory levels both for refined products and crude getting up to storage tops. I mean, that's the kind of like just being full, bursting at the seams, not having anybody to consume the product. So, and to level set this about like how much that means, like the globe only consumes about 100 million barrels a day of petroleum products or of oil. That's about what it is. And so when we talk about a 3 million barrel a day loss, that's 3% of global demand that's just gone. Yeah, so that's the way we think about the total. There's other ways to track it, like with tankers going in and out, but there has been some data coming around from some of the big global traders.
And so if we're down 3 million, then that would explain why Libya being down, close to 1 million barrels a day is nowhere near the offset. Therefore, we've seen 2 million barrels of surplus capacity. You have Venezuela still down, although rumors would be that they're sneaking oil out wherever they do. And I don't understand all that, but that's what people say. And then obviously Russia has lately pushed back on coming in with a supply change. Well, what is your view? Again, this is not investment advice. This is all an educational program. So don't make investment advice based on this. And if you do, it's your fucking fault. But walk me through Russia's thinking right now as part of OPEC Plus and the 600,000 barrel cut.
Yeah, sure. I mean, first of all, Russia's in a different situation than a lot of those, let's call them petrostates are, just a different fiscal situation. But I'll try to put myself in their position and say, like, how did we get where we are in terms of OPEC supply policy? And then how did Russia come into that? And what situation might they be in right now? Like looking back to before the December OPEC meeting, we did some analysis around like what was OPEC likely to do. And we did it in a classic way, which is basically you take total demand in the world, you take away non-OPEC production, you say how much demand is left over that OPEC could fill if they wanted to. And we came up with that number, and we thought that they needed to cut production by about 700,000 barrels a day. And it's about what they did. And so just immediately after that, I mean, you're talking about like weeks after that is when the coronavirus started to come about. And so here they are faced with another, first of all, they have to be able to forecast what they think the demand loss is, both current, like at the peak right now, how big is that demand loss? And also, how will it be throughout the rest of the year? Because once they start to try to turn that policy, they're going to be stuck with it for a while. And so I think there's just a lot of debate, like why should we continue to cut more when we just did, and we don't really have a clear idea how long this is going to last. And so and then Russia is one of those that I'm not sure exactly what their goals are if they're consistent with OPEC, but right. You can imagine that they find themselves in a position of influence in a group that they haven't had influence in before, and they might be willing to wield that a little bit.
So I'm going to try you out with my favorite conspiracy theory. And so I need you to hang with me here for a second. So Russia produces about 10 million barrels a day, yes?
Right.
And how much natural gas does Russia export to Europe and to other parts through their natural gas production?
Well, I don't know the exact number, but I know it's getting a lot bigger, a lot faster. They are building gigantic pipes into Europe.
So check me on this conspiracy theory, right? Russia has recently weighed in that fracking in the United States is a monstrosity, I believe is the word that Vladimir Putin said. And I've quoted the stat that of the 110 BCF a day in the United States that's produced, 67% of that comes from fracking, which is about 75 BCF a day or so. Base decline on that would be roughly 40%. In oil, we have 12.8 million barrels a day of oil, 7.7 from horizontal wells, and 3.8 from wells that came on in the last 365 days. So again, about a 40% base decline. So you would lose 2 million to 3 million barrels a day of oil from the market from the U.S., and you'd lose probably 20 to 30 BCF a day of gas if Russia can help make anti-fracking in the United States happen. And then because they've been growing their gas, as you said, growing the pipes, LNG then shrinks, Russia has higher prices, Russia's economy gets much stronger. What say you to that conspiracy theory? Which is why I would say Russia's not going to cut production as part of OPEC here with coronavirus because they want to hurt U.S. producers.
All right, so this goes back to, I'm going to try to dodge that as much as I can.
I love it. I put him right on the spot. I just had to throw that. So for all people who are against fracking, I need you to know that you're pro-Russia.
Yeah, right.
Anti-fracking is pro-Russia. You heard it here first.
Russia has a history of doubting the technology, the unconventional development in the U.S. They have a history of doubting that technology. And back in the day, I really thought that was more just like, grandstanding. It's like, that'll never last. It's really us conventional producers, including OPEC, that's really going to serve that demand in the future. This will never work. But I agree. It's a different situation now. I mean, the U.S., it produces as much as Russia, as much as Saudi Arabia. So it's a totally different playing field. I will say that, without commenting on what Russia is really up to on that, is that they definitely have different different goals than OPEC. I think that OPEC realizes that they can't push the U.S. producer out of business. And I think they can look back at two real distinct events really in the last 5 years or so and say price didn't push them out of business 2 times, and it's probably not going to happen in the future. So why try? Why try to just crush our own budgets while we try to push somebody out of business that has clearly been very resilient? That's number one. The second thing is, I think OPEC's playing the long game. And I think Russia is too, in a big way. They look out and they say, how much can the U.S. reasonably grow? Because we saw what happened in 16, 17, 18. Whenever we came out of that price collapse of that 14, 15 place, a lot of the declines happened in U.S. production to where all of the existing production, that PDP, was declined and was not declining much anymore. And then all the new wells were able to produce on top of those volumes and grow very, very quickly. At the same time, you had a lot of pipelines being built in the U.S., enabling more production to come to market. And so that growth that we saw really in 17 and 18 may not happen ever again. And so that might be the fastest growth rate that you could reasonably expect would happen in the future. So if OPEC looks at that and says, if that's as bad as it can get, which was, let's call it, 1.6 million barrels a day or something like that growth rate. And I think that over the next 10 years, that global demand will grow by about an average of 1.2 million barrels a day. That means that at some point, me as OPEC or OPEC plus my other partners, I start to be able to get more market share in the future. So all I really have to do is wait this out.
So yeah, I mean, I totally agree. Saudi Arabia, in their prospectus when Saudi Aramco came public, I mean, their reserve life index is 53 years, and Exxon is 17. And so in any normal state of the world, Saudi Aramco would triple their production to 30 million barrels a day to get to an equivalent RLI. And so to me, I totally agree. They have to play the long game. They're thinking about 50 years from now. They're not thinking about today, and $30 oil does nothing for anybody. So let's close the talk on oil. We're going to come back to oil because I want to talk some specifics around hedging. But let's pivot to gas. So at the same time, I've been bearish on gas for a very long time because at 250, the Marcellus can grow from zero to Marcellus plus Utica, so Appalachia, can go from 0 to 30 BCF a day in kind of 10 years, and guys can just pump out as much gas as they possibly want. So we've now seen natural gas move from kind of 225. We were down in like 180, 175. Waha has been trading negative. Walk me through your thesis on natural gas and how bad is sub $2 for producers, and what do you think the dynamics on natural gas right now?
Yeah, so we just recently flipped our point of view from neutral during most of this winter, which we should have been bearish, but yeah, who knows how weather is going to work out? It was the worst demand winter for natural gas in the last 125 years. If we've been burning gas that long, it was just exceptionally mild. You couldn't have predicted it, but we switched to bullish on January 31st, and a lot of it was because of the supply side. There was a demand component too, but let's talk about the supply side first. So let's just group into buckets where a lot of your supply comes from in the U.S. You do have some coming in from Canada, which seems to be slowing just a little bit, but it's not going to move the needle. All right, the big needle mover is going to be the U.S. production inside the country itself. Let's say the associated gas is mostly going to be Permian Basin. And then you have your dry gas basins, which we can really just lump into two. It's going to be Northeast, that Marcellus Utica combo, and it's going to be that East Texas Haynesville. Okay, that's going to be the source of your dry gas. So we can look at the prices there, think about their economics, and so will go the country. All right. So first of all, let's eliminate the Permian for this year, because that basin is already constrained from a natural gas takeaway point of view.
When did the pipes come on? My understanding was it was Q4 2020 is when you have some expanded capacity.
That's safe. We're thinking at the end of the year, so that's safe. Okay. The last one, but this is an important point because we're going to talk about 2020. We can talk about 21 if you want. It's a totally different game. 2020, we think that the Permian Basin can't really increase its gas production much. And when I say it can't increase its production, I mean it can't send much to market. It may get produced, but it's going to get flared. Okay, it's going to get trapped. So it's going to stay back there behind pipelines, behind processing plants, and it won't come to market. It won't get sold. And so we think that's going to be fairly flat because they just don't have any capacity to be able to send it out. So that leaves all your dry gas basins. And we can take the Haynesville and we can take the Northeast, the Marcellus and Utica. So you mentioned that $2.50. If you were able to get $2.50 in basin right now, yeah, you would grow. But what are the current prices people are getting there? Well, Henry Hub right now, let's call it even numbers. It's about $2, for this summer. What's the discount in that region? The basis discount that you get up in Southwest Appalachia, about 50 cents. So that means even before you pay for your gathering of this gas, you're getting a maximum of $1.50 right now for any unhedged gas that is produced this summer. $1.50 is not an environment to grow that basin very much. Some of them, yes, but not on the whole.
Right. So let's talk about, I wrote a post for Technical Tuesday, and I'm not asking for you to comment on specific companies. Leave that part to me. You guys can talk in general sense. But let's look at a company like Antero. Antero has a hedge book that mark to market at year end was worth about $750 million. Their average hedge price for the next 2 years, I think, was in the 280 range. Certainly, they're receiving $1.50. How would a company like that go about monetizing that mark to market? Because my point, and what will come out in the Thursday Technical Tuesday, or I guess it's Thursday now, is that the bet on a gas player is that gas has to be $2.50 because in the $2 or $1.50 you are just not economic. You're effectively a zero. Therefore, if you have a mark to market gain in your hedges, $750 million, you should monetize that because the bet is gas has to go up, and if it doesn't, you're screwed anyway. How would a company go about monetizing their 2-year hedge book to bring that mark to market to cash to be able to pay down debt today?
Yeah. Okay. These are, we've seen a few tactics that we have recommended and just seen lately that I think are relevant for this conversation. Number one is one thing that you can do always is move your hedges around. Just because you have a hedge that is out there that you put on when Cal 22 or 23 or 24, that is the calendar year 2023 and 2024, maybe you put it on when it was 50 cents higher. And as prices have come down, the value of that hedge has gone up by 50 cents per contract. So you've made a lot of money on those, which I think is kind of what you're describing. So what we often see is not just removing the hedges and taking the money and going doing something else with it, but is moving it around to make it more useful. And one common thing has been, because of the front of the natural gas curve has fallen so much, is to be able to take that value, work out an offsetting hedge that allows you to move those hedges to Cal 20, summer of 20, winter of 2021, instead of keeping them on where they're not really doing you much good right now in 23 and 24.
Got it.
That's one way.
So you would bring the hedge, the value, and you'd effectively use that currency to buy a future. And if June right now was trading at 230, and you felt 230 was better than $1.75, and you wanted to de-risk, that's one way you would move. Move it. Did I get that right?
Yes, and you can sweeten the deal a little bit. Let's just say that the summer right now is trading at around 210 or so. And you have all this money that you have made in your hedges in 23 and 24. I might be able to take all of that money and actually be able to work with my bank or my trading counterparty to, instead of hedging at 210 for this summer, well, to juice it up a little bit and maybe get to that 230 like you mentioned.
I got it. Okay. So natural gas, you've moved to bullish at the end of the year because of a supply phenomenon. Now, at the same time, and I'll use Antero again as the example, they're going to grow production by 9% this year because each year that they don't fill their firm transport, their 2019 expense towards firm transport that was unused was $258 million. And so they have a view that if they can grow production, they can save some money against those losses. And so as a result, even though gas is uneconomic, they continue to drill. How much do you think that will morph the view that in a fundamental market, gas should be declining because of prices, but these guys are all limited by these contracts that they can't break and won't break?
Yeah, that's a good one. And also I'll add to it, and you also have to think about all the hedges that were put in place, 12 months, 18, 24 months ago that could be supporting production now too. We have to consider that. So the way we think about it is we think about it probabilistically, and we think about it economically. So we look at the forward curve and we say we know a couple of things. Number one is that ultimately these producers are slaves to price. That ultimately price takes over and dictates what you do. But the second thing is that there's a lot of inertia in this industry to where you can't just say if prices are 10 cents lower today, I'm going to immediately change the way I drill and complete my wells in the next 3 months. That probably doesn't happen. It probably takes time. And so the way we go about it is we recognize the economics are going to start taking over. Usually takes 6 to 9 months before that happens. So in the short term, I see a lot of that, what you're talking about, is inertia from capital that was either put in place late last year or that was already budgeted late last year and now is being spent here in the first quarter of 2020. And so you'll get a lot of that inertia. But once you start getting to the second half of 2020, I think even though you'll have some of those resilient firms that keep growing production for whatever reason, there will be hundreds that will not, because they won't have those obligations or that flexibility or that access to capital or a price environment that encourages them to keep going.
That makes sense. So let's transition to associated gas, and then we'll talk some liquids. But so in the Permian, and I think the big challenge I think our industry faces, and to me, I would regulate it. I know that that's a very bad word for oil and gas people, but the fact that flaring is allowed on long-term basis, and as you said, practically speaking, Waha's trading negatively, so you are literally better to flare it than put it in pipe because you have to pay fees to get negative gas. The flip side to that would be, if the RRC were to come out and regulate it, then presumably gas production would fall. Presumably oil production that was associated with that gas would also fall. Presumably prices would come up and make a healthier market while the infrastructure was being built. And so similar to the Bakken, where they regulated a percentage in North Dakota of flaring, but it took a much, much longer time. Again, I'm not going to have you comment on the regulations, but specifically to the pipe in the Permian and associated gas and some of the challenges. I mean, are we just going to continue to buck up against this, or do you see any relief at all this summer? It's 9 months of negative gas at Waha.
Yeah, this is a great question because it's so important for within the Permian Basin this year. It's extremely important for within the Permian Basin next year, especially when you're thinking about putting on hedges for Cal 21, and I'll point out some reasons why. And then it's also important for the macro view of natural gas throughout the whole U.S. because the Permian Basin has the ability to add a lot of supply all at once. So we got surprised by this a little bit, and it's fair because I think the market got surprised by it too. Looking back to last year when Kinder Morgan put in the Gulf Coast Express, that is a 2 BCF a day pipeline out of the Permian Basin. They were very constrained then too. Prices there had dipped down, fixed prices had dipped down to negative in the cash market, and so there was just no way to get gas out. We thought there's probably about a BCF a day of flared gas that would start coming to market when that pipe come on, and we were wrong by about a BCF a day. It was probably 2 within about 3 months. So 2 BCF a day came into this, and total U.S. production is about 95. So that tells you how big that is.
Yeah. Now, when I see that EIA data and it shows 110, I think that's raw gas. So the 95 would be more of a dry gas stripped out. So 15 Bs is being converted to some form of liquids.
That's right. And we're also only talking about the lower 48.
Right. Got it.
Well, Hawaii doesn't produce any.
Hawaii does not. A lot of geothermal energy there. It's renewable, apparently. So let's talk about liquids. It's not somewhere but I understand that Russia now, I think that they've had some of their lighter condensates be excluded from their OPEC limits. I know that a lot of different reservoirs are producing at different levels. A lot of the Eagle Ford is producing a high API, so it's condensate, so it's oil, it's not oil. It has different purposes. What do you see in the liquids market? And so include condensate in that, but also in the NGLs where, you have butane and ethane rejection and propane and all of those ends. What are you seeing for 2020, 2021?
Yes. Can we start with ethane and propane, and then so hopefully we run out of time and I don't have to talk about condensate?
Yeah, but 100%.
Yeah, well, I'll say something about condensate. Condensate for the rest of the world, they use the word condensate, but they'll also use words like naphtha. And that becomes a complicated market because there's various kinds of naphtha. There's naphthas that come off of refineries and that have a lot of aromatics and cyclical compounds in them that are really good gasoline feedstocks. But then there's also naphthas out there that have just paraffin chains. They're like long chains that don't really do well for gasoline, so you have to use them in crackers and things like that. So it becomes a very, very murky, fractured market, and one that's really hard to figure out what's going on. And it's also dominated by the Eastern Hemisphere. Let's start going with the light ends in the US and kind of give you what's happening right now, because I think we're turning a corner on liquids in the US. And let's just talk about Mont Belvieu. So Mont Belvieu, Texas, where most of the fractionation is. And that's where these NGLs are traded. So for ethane first, ethane for years has traded very close to the value of natural gas because natural gas and ethane can be substitutes. Like you can say, hey, I don't want to send my ethane down to Mont Belvieu to be sold as NGLs. I want it to go into the gas stream, and then it disappears. Okay, it's called rejection. That's what's been happening. And so prices can fall, but when they hit the natural gas floor, they kind of stop because then you have that choice. Ethane is likely to get a lot of new demand in very short order. There's a lot of ethylene plants, often called crackers, where they take in NGLs, they bust up the carbon bonds, they turn them into new stuff, mostly ethylene. And we've been waiting for these things to come online. They're finally coming. It's all during first half of 2020 probably, and ethane demand is looking really good.
And what do we use ethylene for?
Mostly polyethylene. You're trying to make plastic. There's some other things you can do, but it's mostly going to polyethylene. So just assume it's polyethylene.
And so when we look at the economic macro environment in the U.S. and with the impact of coronavirus, one of the things that struck me was how fast things rebound, right? So obviously these cities are in lockdown. I think about the U.S., 20 million barrels a day are consumed, of which 70% is for transportation, which obviously includes some airplanes. So air travel is kind of, if you don't travel, you're probably not traveling. But like inside the city, I would think maybe miles are down half. How much do you think is like this elastic rebound and for like ethylene and plastics and all of the inventory that's being drawn out of inventory now to sell TVs and Apple iPhones and all these things? Like how much do they ramp up production to catch up? And then do we see like a huge surge of demand on the backside of the coronavirus once they stop quarantining? Do you guys have a view on that?
Yeah, so you are right that they can start that process up a lot. What I would say is that if you try to think about the economic impact on the U.S. producer, the spread between that polyethylene price and the ethylene price, so you put it through a plant to convert it from ethylene to polyethylene, that spread between the polyethylene price and the ethylene price is wide enough so that you probably aren't disrupting the U.S. producer right now. There's still margin to do it. There's ability to store it. Storing polyethylene is really easy. It's just pellets. We have capacity to store ethylene. The U.S. market is still running pretty hard. So I don't think it's going to affect the U.S. producer in short order. But yeah, you could see some like a whiplash effect in the Asian markets for those plastics whenever they find themselves with lack of supply or with too much supply.
Yeah, I mean, and it would seem just from again, this is a little bit out of hedging, but if you think about China being shut down, and China manufactures a lot of the goods that come to the U.S., hence why transportation is down so much, and if those items are being pulled out of inventory, you could actually probably see cost inflation here soon because we're going to get short of iPhones. And so therefore, if we don't have any in inventory and China's not manufacturing, you could see inflation, which actually arguably is good for the U.S. economy, because if we had some inflation, then we have a little bit more ammo in the event of a recession. I mean, it's because you can raise interest rates. I mean, is that a fair sort of take on what could happen in a rebound scenario?
It could be. The way it would translate into a benefit for the U.S. producer of oil and gas is that you would start to see a pull on propylene as an export. I think ethylene exports are kind of early in the game, but you could see the desire for more ethylene and from a region that is very reliable. But I would say in the U.S. right now, we rely on that export market quite a bit, and so I'm not sure if we're currently getting a lot of upsets from not having the bid in the Asian market pulling that market up.
Yeah, no, that's totally fair. So let's pivot back to crude oil. Just because I think from natural gas prices are so low and Permian producers is really where the juice is for U.S. E&Ps. That's where it's been growing. That's where all the value is. A lot of the other basins are in decline. what happened in September with the Houthi rebel attack, and what happened with the Iranian attack, and specifically around volume of crude traded in the subsequent days relative to world, daily production, and how many people took advantage of that event to actually hedge their barrels?
Yeah, I can tell you from our perspective what happened. I mean, it was a Saturday morning, and I got woken up with a client calling me and saying, "Hey, what do you think is the importance of this attack on the Saudi infrastructure?" And of course, I didn't say what attack on the Saudi infrastructure. I said, "You know what? Let me get with the team." Well, by that afternoon, we were having meetings with boards of companies and with hedging committees and risk management committees. And so we were having conference calls all that day on Saturday. On Sunday, when the Asian markets opened at 5 p.m. in the afternoon, we had full team, and we saw just that day, I think a million barrels of volume go through. On the Monday that followed, I think we did 10 million. So I mean, over 10. It was huge, and it was very much one of those situations that you look for as an opportunistic hedger to know that, hey, if it's going to take a catalyst to move prices further than they are right now, I need to be watching for that catalyst. I need to have a plan. I need to know who's going to be responsible to sign off on these decisions and be ready to jump on it when it happens. And I'd say our clients definitely were able to do that. Of course, we were doing webcasts and publications like this too.
I got to give a plug to Matt and his team for the work that they did around that. Very proactive, talking with our clients on Saturday and Sunday and setting everything up well. So team came together, and Matt and his group and our trade group just, I think, did a phenomenal job for our clients and took advantage of this situation.
So globally, how many barrels would have traded sort of in the following week of both the first attack on the Saudi infrastructure and maybe the second? I mean, the 100 million barrels a day is the number in terms of global production. And so if you're hedging, the earliest you could hedge is probably March right now, right? February month is, I'd be hedging barrels in March.
Right.
Okay. And so I have 3 billion barrels. Did I do that math right? That sort of will be produced worldwide in March.
That sounds good.
100 million barrels times 30, kind of.
I trust you.
I think I did the math right.
Back in the napkin.
Yeah, back in the napkin. So of the 3 billion barrels that would trade in a month physically, how many multitudes of that are traded as a commodity, as a financial instrument in a given month, if that's a fair way to ask the question? And so like if I look at my CNBC quote and I see like 600,000 contracts trade in a day, and each contract is 1,000 barrels.
Yeah, I know how I would answer that from our clients' point of view. There is data that you can go out to the CFTC where they publish through how much volume that swap dealers are holding, and you can actually get into that and figure out that precisely.
Yeah,
I don't have that one rattling around in my head.
Yeah, and the reason I think about it, and every time I get too optimistic, I watch The Big Short. So I watched The Big Short again yesterday, and the moment in the financial crisis, in the 2008 crisis, was the realizing that it was not just the insurance on the mortgages. It was the synthetic financial product on top of that made the magnitude of the bet 10 or 20 times the size of the housing market. And so when I think about, what's going on in the natural gas world and the crude oil world and the volatility in prices and how people are trading, if 3 billion barrels of oil is produced in a month and consumed in a month, if the magnitude of that trade is 20 billion barrels, there's a huge financial incentive to be just trading, which is a synthetic market, and how much that has been part of moving oil from 62 to 48 to 53 to 60, and moving it. So that was where the question was kind of going.
Okay. Well, I'll tell you, we watched that really closely, and without knowing the exact volume by type of counterparty, I'm not sure, but we watch the speculators activity. Bloomberg calls it managed money. Other people call it other things, but it's speculators, of which I used to be one, and they're not all bad people. I'm reformed.
Yeah. You look, and there's a few, and some are really good looking. So you have that going for you too.
Oh, I'm glad this is a podcast.
Keep it on. It's good.
But I have the face for radio, so that's how that works.
Well, we think about it as a risk skew because, like, let's just take natural gas right now. Natural gas, what speculators will do is like they'll either take a bullish position and they'll buy synthetically, like you mentioned, they'll buy futures swaps, thinking that prices will go up, and so they'll take a long position. Well, they can do the same thing for a short position, like you're talking about the Big Short, similar type of thing. They're shorting this market, and by doing so, they artificially push the price lower. And right now, speculators are holding short positions larger than they have ever.
In both commodities, natural
Not
gas
in both.
and crude?
No, not in both commodities.
Just natural gas.
Yes, natural gas. This is just an example. And one of the risks that they run, and this happened to them in when was that big November? I think it was November of 18. We got so cold in the Midwest. They faced this problem then too because they had been shorting this market. Suddenly, the supply demand balance flipped. It got cold, and they got chased out of those markets. It was like a squeeze, and so prices ran up super fast.
Didn't they run to like 3? Am I remembering that?
Went higher
Like
than that.
It was north of 3. Yeah.
And that was not fundamentals. That was trade flows. That was the speculators getting run out of these positions and having to cover. So we're watching it right now because that's another part of our bullish point of view on natural gas. Now with crude oil right now, they've got a moderate level of positions. There's long. They usually are long. Speculators are usually long. It's not just a play on the price. It's other things. It's its own asset class. It attracts people investing in oil. Okay, so oil's a little bit different. But one of the things that we think right now is that because the speculators are not really holding large positions, if you do get a fundamentally led rally where supply demand tells you that prices go higher and the cash market is getting tight and prices are moving up higher, those guys might have a lot of dry powder. And they've got a lot of risk to deploy, and they might be willing to jump in there and start bidding that price up too.
Interesting. So without making investment advice, if you look to the end of the year, is it fair to say that you think that a bullish number for gas is, with supply demand fundamentals and the changes you talked about, we sort of head to a 250 as sort of like a marginal cost of supply kind of range for December? Is that a fair is that a fair expectation, and is that a cap, or is that like does it go up to 3? Again, I'm not asking to make a specific number, but is 250 by the end of the year a reasonable number for natural gas producers, and then in the Permian it'll effectively stay 0 until that pipeline comes in?
Matt loves to specifically call prices.
Man, like I'm starting to sweat right now. So you know that as a policy, we don't throw out price targets. But I would say that you're in the range that is a reasonable range. And if I had to mark I'll start right there. I can give you some justifications for it if you want.
No, that's totally fair. And so and I think about like a gas producer in the Permian, and in particular, I think about Apache. And again, I'm not going to ask you to comment specifically about Apache, but their Alpine High is predominantly gas. Hedges or no, they're effectively getting 0, where they could monetize a hedge book, and they have 200 million plus a day of natural gas being produced there. To me, walk me through the logic of a producer not monetizing the hedges and shutting the production in and waiting for the 250 versus giving your gas away. Is there any, in your view, again, speaking broadly, not specifically, is there any reason why a producer is keeping that gas on?
Well, the biggest reason in my mind is just cash flow management. And that's one they have to think about, is like keeping the financials healthy and staying on budget there. For economic reasons, sometimes you look at it and say that makes a lot of sense. I mean, I think any business student could look at it and say, well, if next year's priced at 240 and currently it's 210, that seems to be all like, over a 10% rate of return, whatever. You'd be able to do that math.
100, especially if you could use hedging to lock that in, number one. Number two, you could not burn the resource. And number three, I think importantly in the Permian. So for all you Permian producers out there, like think about this. Gas is currently 0. So that's not cash flow. That is like literally you're paying fees and you're destroying your balance sheet. Like, I got to say it because I haven't said this on the podcast in like 17 months. Wake the fuck up and shut in your wells. So if that happens, then we get to 250 faster. Things get better. I'm feel a lot happier. On the crude side, I had a bet with someone, money manager, that we would end the year, December 31st, would be at $63 a barrel. Now we hit it like December 30th, we snuck back, but I still closest to the pin. I still won that bet. Then the Iranian crisis happened, and I was feeling like really good. And my view was because of supply demand, and I view that the U.S. has peaked in production. I think that we're seeing declines in the Bakken. I mean, we will continue to. We've had a cold winter. The new EIA data come out yesterday, and we had very low completion rate in January and December. We see Primary Vision, who publishes their frac count, we see continued at around 310 frac fleets right now, which is lower than it's been in 2018. So we're not completing anywhere near the volume. So I see oil declining in the U.S. from where we are today, which is like 12.9, and ending the year at maybe 12.5. That's my view. Therefore, when the world expects the U.S. to grow 500,000 barrels a day year over year, and I think it shrinks 400, there's a 1 million barrel delta. And to me, I think about 63 is the price at the end of the year. I would have said, aside from coronavirus, I would have said 63 all year, but I think 63 at the end of the year. Is that in the range of possibility, or is there just too much crude and Iran could come on, Venezuela could have something happen, Libya could come back on, and we're just swimming in crude, and it should be a $50 world?
Yeah. So let me offer some other points some other points that could argue against that. So right now, OPEC probably produces a little bit less than 30 million barrels a day. It's just even numbers. Let's call it 30 million barrels a day. But they have shown that they could produce somewhere around 33. All right. So you got 3 million barrels, and probably 2.5 million barrels a day of that is discretionary. Like they took it off on purpose. They could bring it back. And Saudi Arabia is 1.5. How much do you think global demand is going to grow year over year?
I mean, it's grown 1 million barrels a day every year on average, 1 million to 1.5 million since 2008. So coronavirus aside, and again, rebound aside, I would say 1 million barrels would be the growth. Is that a fair
and let's just
number?
be more generous. Let's just say you said somewhere between 1 million and 1.5 million. Let's call it 1.25.
Yeah.
Because the math works out.
Yeah,
Okay.
like it.
So that's 2 years. Like say 2 years from now, demand for oil would be 2.5 million barrels a day more. That's exactly what OPEC's not producing right now. So I feel like there's this option out there that OPEC holds that whenever prices go up, maybe it's because the U.S. isn't producing as much as expected, or maybe demand rises a little bit faster, or there's another upset somewhere else in the world, or some other black swan event like this coronavirus that might happen. They can bring that back. Mm-hmm. And so that keeps a lid on how prices can go. It keeps a lid on volatility. Now, I'll say this. The exception to that is something that we've seen 2 times in the last 6 months, which is what if that black swan event or that surprise happens among OPEC, like Libya,
right,
or like the attack on Saudi Arabia,
right,
or tensions with Iran. Yeah.
So when you talk about a ceiling, now again, this is conjecture and a lot of reading, but generally I've seen that Saudi Arabia needs $65 for their social programs, and that generally 65 would be considered like a good number. So to me, the ceiling feels like 65. When I heard you talk, it sounds like maybe the ceiling is lower. And if it is lower, then U.S. producers are thinking 55. And 55 is a very, very different game for free cash flow and profitability. I mean, within that 55, 65, where do you think the ceiling would be broadly, higher or lower?
Yeah, if we said 65 WTI, what we're really implying is probably about $70 Brent, maybe a little over 70 Brent. And if we judge how OPEC has responded to price signals in the past, you're getting close to that number. The example I would give is like November of 2018, I think it was, when the U.S. was supposed to be putting sanctions against Iran, and it got kicked down the road by 6 months because the Trump administration surprised everybody.
Right.
Well, if you remember what happened right there, prices were going nuts. They were going up fast, and Saudi Arabia decided apparently unilaterally to start producing more oil right at that time. And it made sense. Prices were going up. You thought that all these barrels were about to go off the market from Iran, and so they started producing, and they got surprised by that. But that was a $75 trigger.
Right. And okay. So, and as I recall, that was also like November 18, beginning of November, OPEC meeting in December. We basically went from $73 WTI to $46 WTI
right,
in a straight line over 60 days, which feels very similar actually in terms of shape of the curve to how it's been with the coronavirus. And, now we've started to creep up. So it's sort of like you have these huge shocks that bring oil way down, and then it takes like 7 months for it to creep back to wherever it goes. And then something occurs, typically bearish, that then drops it right back down to 50. I mean, so based on that, I mean, why would producers not be hedging more? And I'll use CDEV because I'm currently an activist shareholder in them, and I'm going to get them sold. But like they've had 2 instances to hedge when prices have been north of 60. 60 is a healthy price. Why are more producers not using guys like you to hedge barrels at 60 if we keep having these drops to 50?
Yeah, well, everybody should, right?
Yeah.
Okay. So let's explain maybe what's going on. First of all, I can give you some good news in that, and that is that we have a really good representative sample of U.S. producers because of the the size of the book that we have and the number of people we help with their hedge portfolios. And I'll say I broke this down. I looked at all of our trade volumes, and I compared it against WTI price, and I separated out by parts of the curve. So I looked out for the rest of Cal 20, so the rest of this year, and I looked at Cal 21, so all of next year, the price is there. And whenever you saw prices move about over 57, we had a lot of people hedging. So I think that producers are learning to take advantage of these things. At least our clients are.
Yeah, that's very encouraging.
And then why don't they do it more? One thing is that not all producers are created equal in terms of size or
Capital structure.
Exactly.
Yeah. I mean,
So
that's one of the things.
so what about counterparty? So if I'm a dude, I'm producing 500 barrels a day. I want to go hedge that. I want to hedge it all. What kind of contracts, counterparty credit risk, et cetera? How am I financing that hedge? It's all well and good to say I'm going to go hedge, but how do I actually do it?
Sure. Yeah. There's ways to do it that doesn't consume a lot of credit, and there's ways that consume more. Typically, when you're thinking about as a small producer to go out and hedge, you're typically doing it bilaterally. So you're not doing it in the open market like you and I would as like a retail trader. You're approaching a bank or another trading counterparty who are typically swap dealers, and they will allow you to trade directly with them. And so what usually happens is they don't charge you a fee to do that. It's just that they embed a discount from market. So they would give you slightly less than what you would see on the screen. And that's the way you pay for that. So there's two basic ways of going about that. Is you could either do swaps, use swaps, which basically just locks in a price, and it doesn't.
That'd be like a fixed for floating. I will take 57, and the other side of the deal will take whatever it is.
Your counterparty. And it won't be cleared. It'll be just with that counterpart. And the other way is you can choose to purchase an option structure if you wanted to buy buy a put, which buys you a floor. Those are the typical ways. Okay. And those would require cash outlay, but the swaps are usually just it consumes credit.
And so everything I just heard is there's no excuse to not hedge. That's what I heard.
We would say there is not.
Right. And at
least you need to have a solid plan about why you're choosing not to.
But that plan can fluctuate and vary, right? And I mean, that's what we see is that we've got some clients that it's methodical and that it's just a conservative approach and sometimes that's based around, their RBL and the mandates that they have there, but it's a more methodical conservative approach. And then we've got some that family office that are more opportunistic that, maybe they're not carrying debt and they can be a little more opportunistic and listening to the market, listening to our view, listening to the advice from Matt and his team and our trade desk on, how to be a little more opportunistic on layering things in.
Well, my very favorite private equity firm, they had two things they like to say. They said the market is the market, and it's not your job to bet on commodity prices. And so I've always taken that to heart. That as a producer, the strip is the strip. I make my decisions, and my job is to produce those barrels the best they possibly can. The investor's job is to make a bet on commodity price. And so to me, I've always been surprised that producers have not hedged more. And because of that, I think part of the reason we're in the financial crisis that we're in. So guys, what an awesome show. I'm going to have you back sort of for like a summer update. I think this was hopefully for all the listeners. It was as educational for you as it was for me. I think it's a fascinating topic when you think about the actual physical barrels and the physical MCF in the market moving and how the global market trades those. So thank you to Matt and Rob for coming to the studio. As always, you can follow us on the web at www.hottakeoftheday.com. Subscribe to our email service so you can get your hot take delivered right to you without having to go through LinkedIn. Archive podcasts are on the web. Best way for us to expand outside oil and gas and start getting a face to the big bad fossil fuel industry is to write a review on whatever podcast app you listen to and say really nice things. That would be great. And until next time, be safe. Be good. Have a great day. Bye for now.